You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Diageo, Mitchell & Butlers, Greggs, Cranswick, M&S, and our sort of US company of the week, or the one with the largest US exposure at least. In fact, I don't know if that's even true. Diageo might have a large... Our last company of the week is JD Sports. Sam, shall I kick us off with Diageo?
Absolutely, a favourite of the show.
Absolutely, and it is one that you now own too. So one
as
that
of today,
we both
hot off the press.
We both have in our portfolios. So it's the distiller, and it has brands including Smirnoff, Johnny Walker, Captain Morgan, Gordon's Gin, Tanqueray, along with Guinness. They had their Q3 trading statement out with third quarter organic sales of $4.4 billion, up 5.9%. Growth was driven by a 3.1% increase in average selling prices, whilst volumes rose 2.8%. All regions contributed positively, except for Europe, which recorded a slight decline in sales. Changes so far to the global tariff regime are expected to bring around $150 million of additional cost. Around half of this is expected to be offset through streamlining operations before any price hikes. Tariffs between the US and China do not have a material impact on the business. Full-year organic sales are expected to increase, whilst full-year organic operating profits are expected to decline slightly. Next year, full-year organic profits are expected to grow ahead of organic net sales, and the shares were up around 1.5% in early trading. In terms of valuation, Diageo has a market cap of £44 billion and trades 17 times forward earnings compared with a 10-year average of 21, and the shares have a prospective dividend yield of 3.6%. I thought these results were really good. I know it has been mixed and difficult time in the last couple of years with Diageo. I think you look at that portfolio and it's got extremely high quality brands that have been around for decades or even centuries. Volumes, I think particularly that was the most encouraging things here, as well as obviously putting the prices up and volumes still rising. How much of that was stocking up before the tariffs came in? Who knows? I think that's, it is a difficult thing to estimate. In terms of issues though, I think we have discussed them before on the show. One of them being Gen Z and consuming less. So obviously that's going to have boiled down to what overall volumes are doing. And then the second is GLP-1s. We touched on that before with Terry Smith. So with things like Wegovy, Ozempic and Mounjaro, those type of medications, reducing how much people are going to want to eat certain types of food, and also whether it's going to impact on how much alcohol in general they consume, and again, negatively impact volumes from drinks manufacturers like Diageo. There might be more of an argument that it could impact some of the brewers more. So Heineken, for example, where it's really sort of volumes are absolutely key, and there's only so much premiumization you can do. I think there's probably a lot more scope with something like Diageo when you've got, for example, a Johnny Walker, and then you come out with a more premium version of that, which you can charge more. So even if volumes are remaining the same, you can increase the prices and maintain decent margins on those premium brands. That being said, I think probably worth touching on Latin America and the Caribbean. That was the biggest issue last year with a drop in volumes and the general macroeconomic environment beginning to catch up in that region. They have rebounded somewhat. So again, that is encouraging. And then just to touch on the tariffs that I'd mentioned earlier, I think they're set to bring in around $150 million of costs annually, according to Diageo, or around 2.5% of last year's underlying operating profits. They are hoping to offset around half of that with, as mentioned, the streamlining of operations. And then they're going to try to be lean on the price hikes to help offset the rest. it will probably take some time to enact, and the picture on the tariffs, as we've seen, is changing a lot. So who knows what the figures will actually be in the end. Taking all of that into account, it does seem cheap at 17 times earnings, and probably around the cheapest that we've seen it. Now that you've got some of those more positive results coming through, I like it and very happy to hold it. I have topped up on it in small amounts over the last year, but I still do like it.
I would agree. Obviously, I like it because I bought it today, but I think from my perspective, I think we said last time we covered it that I was seriously considering buying it, and that's when the results were poorer. You then look at the share price; it's kind of stayed at the same level, but then the results now are getting better. So I probably would have expected a stronger reaction from these results. From my own perspective, when I came to look at it, I almost couldn't believe my luck when I saw the price was still where it is. Now, it could be wrong, and like you say, it could be people stocking up before tariffs, but I don't know. I think because the results only go to 31 March, it still seems a bit early for me. I think you might have more of that in the next 3 months, for example. So even if it was to reverse again, I just think with the quality of the brands they've got, although, like you say, less people are drinking, I think they've got a lot of premium brands. So as you get more premiumization, I think they're well placed to deal with it. And I think as well, you look at the impact that tariffs would have on the business. I can't say that concerns me too much. It's pretty minor in the grand scheme of things. It's offset by the cost savings they're looking to implement anyway over the next few years. And I just think that worst case scenario is in 3 or 4 years, someone else is going to come in and undo the tariffs in any case. So for a business of this quality to get it at that price, nearly a 4% dividend yield, yeah, even if, like you say, these results are better just because people are stocking up before the tariffs, I'd still be happy holding it long term. But I don't think it is that, but I guess we'll find out in 3 months.
Yeah, no, absolutely. And I assume that's the reason that you bought the shares.
Yeah, so I almost looked at the price and had to do a double take, really. I would have expected a stronger reaction on those results. It might be the market knows something I don't, but I think that's kind of sort of almost on the defensive side. I think the brands are so high quality that longer term, I would still expect them to get back to growth again anyway. So if it takes a bit longer, I don't really mind. So I felt like there's quite a lot of downside protection at these prices, especially for the quality of those brands.
Yeah, no, absolutely. Okay, on to Mitchells and Butler.
Yes, so Mitchells and Butler, I think this is a debut. So for anyone who's not familiar with Mitchells and Butler, which is probably most people, you may be familiar with some of their brands. It is a mix. They've got some good ones and some you've probably not heard of, but the main ones that stick out to me is they've got All Bar One, Harvester, which I do recognise, although I wouldn't particularly rate it that highly, Toby Carvery, which I think probably is a bit better, Miller and Carter Steakhouse, and then they've got some other ones which I don't particularly know, but they've got O'Neill's, Orleans Smokehouse, Sizzling Pub and Grill, Stonehouse Pizza and Carvery, Vintage Inns. So there's a lot of it's pubs, actually. Anyway, they've come out with their half-year results, and first half like-for-like sales grew 4.3% to 1.5 billion, almost entirely driven by higher prices. This growth, combined with cost efficiencies, drove a 10.4% increase in operating profit to 181 million. Free cash flow fell slightly to 213 million, reflecting higher capital expenditure, and net debt, including leases, was 1.3 billion. Like-for-like sales in the 10 weeks preceding the announcement rose by 6%. Full-year operating profit is expected to be at the top end of the current consensus forecast, which ranges between 304 and 326 million. And the shares were up 4.3% following the announcement. It's worth mentioning that rises in the national living wage and the employer NI increases will contribute 100 million of additional cost headwinds. And next year, the cost headwinds are expected to outpace inflation and rise around 6% prior to any mitigation taking place. Just before I go on to the valuation, in terms of the financials, if you go and look at it over 5 years, revenue has gone up a good amount. So 2020, was COVID 2020 or 2021?
2020.
Okay,
I mean, the restrictions obviously continued into 2021.
Yes.
There's still a big picture
so
there.
It's grown from 2020 1.48 to 2.61 billion, but I've only got back 5 years, but 1.48 that That was down 34% the year before, and that will be because of the COVID. So yeah, so it's probably grown more like, well, it's not grown, it's probably grown like 20% over 5 years. Gross profit, that's 1.94 billion, up from 1.1 billion, which again was down by a third. So it's probably again up about 25%. Earnings per share, been pretty consistent. I think if you strip out the COVID years, it's been quite steady growth, although it has been growing. When you look at the balance sheet, I know that 1.3 billion of debt, which is high, includes the leases, but when you strip out the leases, it's actually still got quite a lot of debt. In terms of the cash flow, I wouldn't say the cash flow's been amazing in any of the years in question. So the best year for free cash flow was, well, actually the current year, so that was 232 million. But with a business like this, a lot of the time, that's probably just because they've not had to spend as much on CapEx. That'll catch up with them in another year. But even then, 230 million, market cap 1.7 billion, so maybe kind of 9 times free cash flow. In terms of the valuation, it trades at a forward P of 9.6, and that compares to a 10-year average of 10.9. And it doesn't currently pay a dividend, although the prospective yield over the past 10 years has been 0.8%. I think these results are decent, but then given it's been entirely driven by higher prices, when you look at those brands and a lot of it being pubs, I don't think they have a huge amount of pricing power. I think they're in very, very tough industries because basically all their businesses are affected by the living wage and NI increases quite significantly. And that's going to wipe out probably half of free cash flow. And I don't think they can offset it. I think the brands they've got some decent brands in there, but I think there's a lot of very average brands in there. Probably the only brand I'd maybe be interested in as a separate business taking a look at would be the Toby Carvery, but there is just so many bar and pub brands around it that I wouldn't be overly interested. So good to cover it because it's quite a few well-known brands that I hadn't realised were actually publicly listed, but it's not a business I'd be interested in taking a closer look at. What about you, John?
It's the industry for me. I think it's so difficult to be successful. And also, if you're trying to, achieve growth in this industry, incredibly hard. And I don't see the government making it any easier or being sympathetic in any way to the industry. So I just wouldn't touch it.
Should we move on to a business that's doing well, but also in a difficult industry?
Yes, absolutely. So Greggs, I'd probably say it's been a favourite of the show in the past. They had a trading statement out last week with the group reporting sales growth of 7.4% over the first 20 weeks of this year to £784 million. Like-for-like sales in the company-managed stores grew 2.9%, an improvement from the 1.7% growth seen in the first 9 weeks of the year. The store estate rose by 20 over the period, taking the total stores owned to 2,638, and management remains confident in delivering the target of 150 to 150 net openings this year. For reference, Greggs owned 80% of the stores and 20% are franchised. The group's full-year expectations remain unchanged, including anticipated cost inflation of 6%. Market consensus points to revenue growth of 8% to £2.2 billion for 2025, and the shares were up nearly 7% in early trading. In terms of valuation, Greggs has a market cap of just over £2 billion and trades at 14.6 times forward earnings, compared with a 10-year average of 22.9. It has a prospective dividend yield of 3.5%. I thought these were decent results, but you have seen the share price come off fairly significantly, about 30% over the last year. And I think there are a couple of things. One, as we've talked about before, it does feel like it's now approaching saturation point. Certainly when we started covering it and when we started the podcast 5 years ago, or getting on for 5 years ago, it certainly didn't feel like you had that many Greggs in the south of England. It was northeast and particularly Newcastle where it started, loads and loads. But now I think you are feeling that you're seeing them everywhere in the UK. And I think that brings into question how much growth there is left. That's, one concern. I think the other concern is, as they mentioned, with sort of cost inflation, 6%, and again, NI, minimum wage, they're at the sort of lower end of the market, and maintaining the growth, volumes, and probably going to have to hike the prices. I think that together is going to be really tough for them. So I think that's probably why things have come off quite a lot. We've talked about it in the past. Where does growth come from if it's saturated in the UK? I'm not sure that on the continent, for example, Greggs would go down particularly well. We've seen lots of businesses going to the US and fail. So it does feel like a UK growth story that may be now slowing down and possibly coming towards an end. And I think looking back, when the signs were there post-COVID, maybe that had been the time that I should have bought shares. I didn't. I think it's, good quality business, but I don't think I would be wanting to buy in potentially at this price with the growth prospects as they currently look. Sam, what are your thoughts?
I think it's really interesting that Greggs has pretty much the exact same expected cost inflation for the next year as Mitchells and Butlers, given how similar the industries are, both at 6%. In terms of Greggs specifically, I agree. I don't see where the growth comes from. I mean, we've seen it before where they're having the stores open later as well. And they've still only got just under half of the stores that are open until 7 p.m. or later. I think the issue is it's not going to be 100% of the stores. There'll be some where, just because of where it's located, you probably can't. And there are probably a lot of the lower hanging fruit they've now grabbed. I mean, in fairness, a few years ago, I didn't think they were going to get to 3,000 stores. I thought I probably thought they were more saturated than they were. I think now they probably will hit 3,000 stores. But like you say, where do they then go next? I guess the only counter argument would be that dividend yield's looking quite attractive now. So it's 3.5% prospective yield. Forward PE's 14. I think what will happen is they'll get towards their 3,000 stores. The PE might start to come down a bit as the earnings go up, and it might just be a business that starts to trade at a lower valuation. So you wouldn't surprise me if in a few years' time you'll see this business at a PE of 10, just because there's not really that much growth left in it. I think the issue is if you're buying it now, whilst that might mean it maintains the current share price and you might then get a decent yield from it as they start paying out higher dividends instead of reinvesting into more stores. If you are looking for a bit of growth, I'm just not sure where you would go next, Greggs. There's not anything obvious. So I think what will happen is it will kind of shift towards more like an income stock valuation over the next few years. And I think if you're buying it now, how are you going to get a market beating return from it? That would be my concern, because you might do fine, but if you're buying it for that growth, I'm not sure where it comes from. And I think I'd rather just kind of watch it. And if you could get a decent yield from it in a few years when the growth's gone, it might be attractive for different reasons. But at the minute when it's kind of transitioning between the two, I'm quite happy watching from the sidelines. Whereas I'd say probably go back a year or two, I was feeling a bit more annoyed, like you say, that we hadn't taken advantage in COVID. Whereas now I'm quite happy just watching it.
Yeah, no, fine. Okay, on to another growth story, Cranswick.
Yes, so it's a business we have covered multiple times before. So Cranswick, they are the meat producer. If you're not familiar with them, you may be more familiar than you used to be, given they have been in the news quite a bit recently, which we will cover later. So Cranswick, leading UK feed producer, have announced their preliminary results for the 52 weeks ended 29th of March 2025. And revenue was up 6.8% to 2.72 billion. Like-for-like revenue was up 6.4%. And in fact, that's over 52 weeks. The reported change was only 4.8% because I think last year had an extra week in, so that's why. So up 4.8% reported, but if you were to compare it on a 52-week basis, it would be up 6.8%. Adjusted group operating margin is up 48 basis points from 7.1 to 7.6%. Return on capital employed is pretty much flat at 18.5%. Dividend per share is up 12% to 101p a share. The operating profit is up 14.2% to 190 million. Profit before tax is up 14.6% to 181 million. And the earnings per share is up 19% to 250p a share. Volume grew 7.7%, driven by the premium product range growth and record Christmas trading. Fresh pork export revenue was 10.2% ahead following the Norfolk site China license reinstatement. Pet products revenue increased 47.8% as onboarding of Pets at Home business continues. Poultry revenue was up 20.3%, driven by new cooked and prepared poultry retail listings. Free cash conversion of 101.6%. They've highlighted long-term supply agreements with strategic retail partners secured and expanded, including 10-year sole supply of British fresh pork, sausage, premium bacon and cooked meats with Sainsbury's. £24 million acquisition of JSR Genetics completed, a leading UK-based pigs genetics producer. They've done a £32 million acquisition of Blakeman's, a leading food service sausage manufacturer, and that completed after the year end on 16th of May. They've invested further in the pig farming operations with a 14% year-on-year increase in pig production, and they now have almost 1 million pigs on the ground at any time, up 19% from a year ago. They've invested in the farming operations to secure supply and drive productivity improvements. They've recorded capital spend of 138 million with significant progress on the pipeline of earnings enhancing major capital products. That includes £29 million expansion of the whole poultry sites, £25 million Worsley hummus and dip facility, £22 million investment in incubatory capacity at Kennington Hall site, £62 million multi-phase expansion project at the whole pork processing site, and a further £35 million now committed to the whole pork's processing site capacity to bring it from 35 to 50,000 pigs per week. So I think these results are excellent. So for anyone who's not seen it in the news, Cranswick were embroiled in scandal last month when undercover footage emerged from their Northmoor farm in Lincolnshire. And this basically showed workers engaging in illegal and inhumane practices, including killing piglets by swinging them by their legs and slamming them against concrete, a method banned under UK law since 2022. I do find it quite staggering that that was an allowed method of slaughter as late as 2022. But anyway, that's a separate issue. They were also beating pigs with metal bars and leaving the animals to suffer in distressing conditions. So they faced a backlash from that. Major retailers, including Asda, Morrisons, Sainsbury's and Tesco, suspended Northmoor Farm as a supplier. The share price dropped by about 7%, although it's difficult with stuff like that to know how much of it solely was due to the Northmoor Farm and more due to what was going on generally in the stock market. And they suspended the team at Northmoor Farm and halted the supply of pigs from the farm pending investigation. They've also launched a fully independent expert veterinarian review of all their animal welfare policies and confirmed that no pigs from Northmoor Farm would enter the supply chain. In terms of the impact, apart from any reputational damage, I'd expect it to be minimal. So Northmoor Farm only houses about 6,000 pigs, and Cranswick currently slaughter about 34,000 per week. So given Northmoor Farm's size relative to Cranswick's total pig operations, which would be 6,000 pigs out of nearly 1 million on the ground at any time, it's a very, very small proportion. And it said even if all 6,000 pigs were processed in a single week, which is unlikely, that would still be less than 18% of the weekly slaughter, and you'd then have to wait until they've reared a new batch of pigs. So it's likely the proportion of revenue is actually under 1% from Northmoor Farm. So I do think the only damage is probably reputational. I'm just mentioning this for completeness, but unless there is something in the investigation that turns out that this is happening across the board, I wouldn't expect this to have any kind of material impact on Cranswick as a business. In terms of the valuation, Cranswick now trades at a P ratio of 19 and a dividend yield of 1.93%. We did mention this last time we covered it, but it's done pretty well since we started covering it on the show. So it's up 70% in the last 3 years, which I'd guess is around when we started looking at it. I think Northmoor Farm aside, it's a really, really well-run business. I think the acquisitions they've been doing, the investments they've been doing, the hummus side of it, what they've been doing with finding the additional revenue streams, not just the hummus, but also like the pet food. They are using every part of the animal. I think they've also been quite big beneficiaries of Brexit, actually, because I think it has resulted in much more of a drive for like British pork, British beef, whatever else. But yeah, I think it's been a really, really well-run business. And I just kind of wish I'd spotted that a few years ago, because I feel like we should have done. Whereas now, when you look at it at 19 times earnings, it's a business that I would back because of how well run it is. And equally, they are expanding a lot, but it's kind of similar to Greg's. I think there's a lot of growth that's been had that I think should have been easier to spot, whereas the growth going forward, although I'd back them to do well, it's definitely not a no-brainer at 19 times earnings. So I just wish I'd kind of realised couple of years earlier what a great business it is. What about you, John?
Yeah, I think I feel similarly to Greg's. I don't think I'd have that much more to add than what you've already said. I really don't like to see the Northmore abuses going on and feel very uncomfortable about that. But as you say, it does seem to be an isolated incident and very, very small part of their overall supply chain. In terms of anything else to add, I think the only sort of slight worry that I would have and wonder about is, on the one hand, it doesn't look like there's going to be a US trade deal that includes sort of agri-foods. So from that perspective, I guess Cranswick are quite protected. There's not going to be cheap meats coming in from the US to sort of undercut their business. On the other side, I'm not sure what the new deal with the EU means for Cranswick, and if that dividend that they kind of got from Brexit, and there'd been more of a drive towards having British meats for, I guess, people living in the UK, whether that's going to shift at all if we become close to the EU again, and whether that will have any material impact on Cranswick. My feeling is probably not anything too significant, and it seems to be so well run and have so much of the market tied up, it probably wouldn't be a problem anyway, and maybe from an export point of view, it even benefits it. But that's the only other thing I'd have to add. It's quite expensive, but I guess for a quality business like this, you probably pay up for it. So for me, I'm not quite there, but maybe, as you mentioned before, I'm anchored to a price from a few years ago. It's very difficult when that happens, and we may never see that price again. So yeah, but I can't quite bring myself to buy shares at the moment. But I think excellent business overall.
Should we move on to another business that's been embroiled in scandal recently?
Well, yeah, a scandal. It's been the victim of a cyber attack, as a few businesses have been. That's M&S. So we have covered it a few times on the show before. They had their full year results out, with sales rising 6.1% to £13.9 billion, driven by food and fashion, home and beauty sales growth of 8.7% and 3.5% respectively. Both divisions grew market share in the period, and underlying pre-tax profits grew by 22.2% to £876 million, against a consensus of £840 million. And this was helped by top-line growth and structural cost-cutting initiatives, which together more than offset the operating cost inflation. Free cash flow was broadly flat at £410 million, and net debt improved from £2.2 billion to £1.8 billion. Since the year end, a cyber attack has impacted on operations and led to a pause of online shopping in the fashion, home and beauty divisions. Disruption is expected to continue into July and cost the group around £300 million before insurance and mitigating trading actions. No full year guidance has been given. Final dividend of 2.6 pence per share was announced, taking the full year total to 3.6 pence a share, which is up 20%. And the shares were down around 2.5% in early trading. In terms of valuation, the group has a market cap of around £7.5 billion and trades at 12 times forward earnings, compared with the 10-year average of 11, with a prospective dividend yield of 2.1%. I thought this was a fantastic set of results for M&S, and the group really has been turned around. It feels like we've been up and down quite a lot with turnarounds, and I don't know, last 10, even 15 years, it feels like we've been discussing the turnaround at M&S, but really it felt like taking shape now and in a good state. And then comes the cyber attack. It's very difficult to say exactly how much this is going to cost the business. I suppose it's, how much it's going to hit operating profits. One estimate is 300 million, and then apparently the group have insurance in place which will cover about £100 million of that. And then I suppose it goes on to, well, what's the reputational damage? And that being much, much more difficult to gauge. I know we've covered quite a lot of businesses. There was Equifax a few years ago, and a number of others, big businesses that have had cyber attacks. And it feels to a degree like the number of cyber attacks that happen now, and them, hitting well-known household names, possibly they get a bit more of a pass of it when this does happen because it's so much more common. And I'm not sure how much trust people now lose in a business like M&S if it has been a victim of a big cyber attack, because it's much more commonplace. That being said, as a business, whilst operationally it feels like it has done an incredible job of turning it around, I don't particularly like the sectors that it operates in. I think there is going to be the cost inflation that's coming through in terms of national insurance, minimum wage. And I think from a growth perspective, I would just be looking elsewhere, cyber attack or no cyber attack. But that being said, management, fantastic job overall. And I don't expect the cyber attack for us to be talking about that in 3 years' time with M&S. Sam, what are your thoughts on these results and the cyber attack?
I think the results are absolutely excellent. I don't think there's really anything in the results that we can criticise. The issue is the cyber attack. I agree that in terms of reputational damage, I think people are pretty forgiving. I used to work somewhere that had a cyber attack, and I was stunned by the amount of clients that left in terms of how low it was. I think people kind of just know that your data's out there with so many different people. It's going to get lost at some point by someone, and that's just part and parcel of the internet. I think people are pretty understanding of that now. The difference, I think, with M&S in terms of the cyber attack impact is I think so I actually do my food shop at M&S, and what I noticed with the cyber attack was I think it went on long enough that it might have started to change some people's habits. And I think that's the issue with it, because I remember the first week, it's like you go and half the shelves are empty. It's like, oh, well, that's a bit annoying. I'll go into Morrison's afterwards instead, or Aldi or whatever else. And you have to go to two separate places. The second week, it's really annoying. And then by week 3, it's like, well, actually, I'm just going to go to Tesco until it's sorted, because I don't want to have to go to 2 places. I quite like M&S, so I've gone back. I think a lot of people will have done once they've started having everything on the shelves properly. But I do wonder, particularly in the south, if you're somewhere where there's an M&S and a Waitrose next to each other, for example, and you started going in the Waitrose, how many of those people have kind of broken that M&S habit that wouldn't have done? I think long term, it's not going to make a huge difference, but I do just think the impact on the business could be a bit worse than just the headline numbers. But longer term, I still don't think it's huge. I think for me, it's probably not at the moment a business I'd be particularly interested in. I think had I recognised that this finally was actually the turnaround, maybe we could have done very well. But like you say, it's been turned around so many times. I think now, when I look at it at that forward P of 12, that's with the unknown of the impacts of the hack, the data breach, which I think is going to be quite high. So it's probably going to end up being more expensive than that, because it's going to take a knock. But as well, I just think, well, you can get it at a similar PE to Tesco. Tesco got a higher yield. It doesn't have the data breach. For me, it's one where it's, well, if I were wanting to buy a retailer or a grocer, I'd probably check back in a year or two with M&S and see how the price compared to some of the others, because I think for what you're paying, it's in line with other supermarkets that don't have the current issues that it's got.
Yeah, no, absolutely. Okay, on to JD Sports.
Yes, our not quite US company of the week, but because there was a lot of UK companies reporting earnings, we've decided to do 6 of them instead. But JD does have a lot of US exposure. I think US is now JD's biggest market, so we'll semi-count that. So JD Sports have come out with their full year results, and full year sales grew organically by 5.8% to 11.5 billion, ignoring the impact of exchange rates, and all regions saw growth except the UK. Underlying profit before tax was 923 million, in line with guidance, but down 2.9% on the previous year. Profitability was impacted by lower gross margins, increased infrastructure investment, and higher borrowing costs related to the recent Hibbett and Courier acquisitions. Free cash flow was improved by 100 million to 700 million, and net debt rose from 1.5 billion to 3 billion, which reflected increased borrowing to finance acquisitions. Organic sales growth in the first quarter was 3.1%, in line with expectations, and no full-year guidance was given, but the market consensus points to a full-year underlying pre-tax profit of 890 million, which I think on net debt of 3 billion, the net debt, I think that's reasonable. I think it's manageable at the very least. And final dividend was up 11.1% for the year. And the group has commenced a share buyback program of 100 million, which it expects to complete by the end of July 2025. One thing I do like there is it is nice to see the business doing a share buyback program when the shares are at very, very low valuations compared to historical levels. We do normally see the opposite. So I do think credit to management there, because it's a fairly brave decision, because they could have just done a bigger dividend. Currently, the US market is in a bit of a sticky patch. So that's due to, well, the tough macro, product launch delays in the US, heavy discounting by peers, and JD's been holding firmer on their pricing than competitors who've leaned into more promotional activity to clear the stock. But JD has resisted doing that thus far because they don't want to tarnish their reputation as a more premium store. And as mentioned, the US is now JD Sports' largest region by sales, and that's following the Hibbett acquisition that was mentioned earlier. And a lot of the goods sold there are manufactured in countries like Vietnam and China. So we don't know the impact of tariffs, but it would affect JD fairly significantly. Market forecast for underlying pre-tax profits of 890 million point to a slight decline, but that does include the impact of tariffs. I would caveat that including the impact, I think that's probably just a guess, really, because I don't think anyone knows the impact at present. In terms of valuation, business trades at a forward P of 7.5, and that compares to a 10-year average of 16, and the prospective dividend yield is 1.1%, and that compares to a 10-year average of 0.5%. I think for me, there's quite a lot of long-term concerns with it in terms of the big boys like Nike and Adidas. I think they are longer term still going to want to improve their direct to consumer. I think there's going to be less exclusive deals with JD. That being said, I think JD is doing everything it can. I wouldn't want JD because I wouldn't be keen on retail particularly, but also I recently added Nike, and I think there's just too much overlap there in my portfolio. I think as well, obviously 7.5 is still pretty cheap, especially compared to historical levels for what I think is still a quality business, although there are some long-term headwinds in my view. But considering that a month or two ago, this was a business we were talking about that was trading at like 5.5 times earnings, I think if I were to have bought it, I'd have wanted to have pulled the trigger then. I don't think I'd pay 7.5 now, having seen it so cheap. I know I'm probably anchored to it, but it's not a business I'm overly interested in anyway, just because of the amount of overlap with Nike. John, what are your thoughts?
Yeah, similarly, I think for me, the main thing is the shift towards direct-to-consumer by the big boys. And I feel uncomfortable owning JD. It does seem like it's a shrewd operator, but that's the main concern. I'm not desperate on retail, having been burnt already by Boohoo. Appreciate they're completely different types of business, but that is in my, scorched into my memory, really.
So in that case, of the 6 businesses we've discussed this week, Diageo, Mitchells & Butlers, Greggs, Cranswick, M&S and JD Sports, which do you like the most and which do you like the least?
It's a difficult one. I think I would probably go with Diageo first. I think incredibly high quality portfolio of brands, and it's certainly not looking expensive at the moment. And last, it'd probably be Mitchells & Butlers, actually. I don't think it's a bad operator. I think it's the industry, and it's going to be a difficult few years, I think, for them.
Without sounding boring, my favourite and least favourite would be exactly the same. Oh, I would add as well, I keep forgetting, I've been meaning to for a while, but if you've made it this far, it's a good sign because you probably like the show. But we've got but our average rating on Apple Podcasts is 4.2 compared to like 4.8 or something on Spotify. So if you are listening on Apple Podcasts, please could you give us a 5-star review? I wanted to do it at the end because I thought there'd be more people at the beginning that maybe don't like us as much. So if you've made it this far, please give us a 5-star review on Apple Podcasts. But I think that's it.
Well, thank you very much for listening, and hopefully we'll be a little bit more exciting, or we'll have a little bit of difference in opinion next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.